Sandeep Jain, the Managing Director, and Sumit Sood, the CFO of the company, now joining in. Gentlemen, congratulations and thank you for joining in. Sandeep, I think that EBITDA margin number that Ekta was telling us, 12.2% on an adjusted basis, is still much lower than the industry average. Can you explain why that is? And also, is there visibility, or does your business model have the levers to improve margins from current levels?
So the way we look at what she's explained is the overall EBITDA margins of the group. The way the margins are for the CDMO business, they are at 15%, right? We think that the margins are going to be stable at 15% for our CDMO business, which she mentioned is almost 94% of our EBITDA. But some of the smaller businesses which we still are investing in, once they turn profitable, our overall margin should see a jump. So I think we are into contract manufacturing. The margins have been kept that way.
Okay, so how long do you expect these other businesses to drag down the consolidated margins? When do you expect a turnaround in them?
Ma'am, so the API business, the way we look at it, by the end of this year should turn around. And the marketing business also, we think by the third quarter this year should turn around. Coming back, while she was explaining, the anchor book was of 31 people. And in the anchor book, we got all the marquee investors. We've got Capital, we've got BlackRock, we've got Adia there, we've got SBI Life. So just to name a few. So I think it's a strong asset, and that's the way we look at it right now.
Got it. Yeah, you do have several marquee names in the anchor book, no doubt about that. We're just trying to understand the business model a little more. Let me bring in Sumit Sood, CFO of the company as well. Sumit, just take us through the debt levels right now, because again, compared to some of the listed peers, your debt levels are a little more elevated, close to, I think, 0.7 times. What's the plan there? Will you be utilizing some of the proceeds you raised to pare down debt? And what's a comfortable level that you'd like to target, eventually in the medium term?
So, ma'am, the fund-based debt are around 447 crores, right? And we have cash and cash equivalent, which is around 280 crores. So our net debt is around 220 crores. So, so of the proceeds of 680 crores, we'll be paying 387 crores for the debts. The cash flows of the company are very strong, so we think that we should be on a no debt position. Just to let you know, the term loans on the company are 123 crores. What is high is on the debt side, what it is showing higher is the working capital. So I think that's in the inventory and the debtors. So we should be debt free.
When? Sumit, you said that you should be debt free by when? I mean, is it this year itself?
Post our listing, ma'am. Just post our listing.
Post listing. Okay, got it.
Post listing, we should be debt free. Yes.
Got it. Let's get in a word from Mr. Jain as well. Mr. Jain, just give us some more perspective on the strategy now in terms of growth. There's the CDMO business, there's the formulations business. What is it that the company will focus on to drive growth? And again, I know you can't talk numbers, but in terms of an aspirational top-line run rate, multi-year run rate, I mean, do you tell your team to target 20%, 25%? What's the overall big picture game plan, and which segment will drive it?
Yeah, ma'am, we are the largest CDMO player, and we want to be in the CDMO space, mostly into the CDMO space. Presently, we are the largest in the country, but we are 25th largest in the globe, in the world. Means we do have 24 more spaces which we have to climb the ladder by 24 ranks. And we are two of our plants are European GMP. They have got European GMP just an year back. Now we are trying to leverage those two plants for international market as well as for CDMO space for some for some different players. This will be the first lever. Then, as far as marketing is concerned, we are there into marketing, and we will multiply this marketing business as well. API business, we are not into hurry to double the production or triple the production. We just want to scale it up at least for the EBIT margin to be in positive initially.
Now, you mentioned two, geographies in Europe where you've got the GMP. I believe your target is to, increase exports to about 25% of your total revenue. They're at 17% right now, Ekta was telling us. So by when does the scale up happen? And again, internationally as well, which are likely to be your biggest geographies, say by the end of the year?
See, ma'am, we are already there into 65 countries, and now we are moving up for some European countries, and as well as the countries which have been left. By when, say, 25% is the target of this financial year alone.
Okay. Sumit, branded generics is about 16 to 17% of your sales. What is it growing at? And if you can give some guidance on the further scale up in branded generics.
Right. So the way our business over the period 21 to 24 has grown is at a CAGR of 15%, right? So if we specifically talk about the branded generic business, we think we will continue to be growing specifically at that business at around 20% year on year.
Okay, so 20% growth in branded generics should continue. And
Yes.
In terms of revenue contribution?
Ma'am, I think the largely the revenue contribution will remain the same because the CDMO business would also grow, right? So I think overall, it should remain the same. We'll sort of have 75% of revenue from CDMO.
Okay, thank you very much, Sandeep and Sumit, for joining in. We wish you all the very best and look forward to more regular interactions. Get into a break. On the other side, we'll put the spotlight on the big movers in today's trading session. We'll kickstart with the power stocks.